Have you ever walked into a massive echoing warehouse packed to the ceiling with thousands of stacked pallets and thought, wow, buying stuff for $1 and selling it to stores for $2 must be the easiest way to make $1 billion? Well, hold on to your forklifts because the actual reality of running a commercial wholesaling empire is a high-speed, heart-pounding mathematical thriller. It is a world where you survive on razor-thin margins, dodge sudden supply chain disasters, outsmart ruthless retail buyers, and play a dangerous game of financial chicken with millions of dollars in inventory. If you want to crack the code on how the ultimate volume titans print money while others panic over pennies, smash that subscribe button right now, turn on notifications, and let's dive straight into the brutal math of wholesaling. The paradox of the microscopic margin. In the glamorous world of retail, brands can double or triple their prices, but in the unglamorous trenches of commercial wholesaling, you survive on microscopic margins. We are talking about a brutal numbers game where your net profit margin on a transaction might hover between a tiny 2 to 5%. If you buy a massive bulk shipment of goods for $1 million, you might only pocket a clean $20,000 after shipping it out. To the average outsider, that sounds completely insane and incredibly risky. But the secret weapon of a wholesaling kingpin is pure, unadulterated scale. You aren't trying to make a fortune off a single sale. You are trying to move millions of units a day, turning a tiny fraction of a penny into a roaring mountain of cash. The velocity of capital and turnover. Because your profit margins are paper-thin, your entire financial empire relies on a hyper-aggressive metric known as inventory turnover velocity. If your inventory sits quiet on a warehouse shelf for more than a few weeks, it stops being an asset and turns into a catastrophic financial black hole. The math dictates that you must constantly flush your capital through the system. You buy from factories, ship to your warehouse, and flip to retailers with lightning speed. The faster you spin that capital wheel, the more times you compound that tiny 5% margin throughout the fiscal year. A wholesaler who flips their inventory 20 times a year will absolutely obliterate a competitor who only flips it 5 times, regardless of who has the lower baseline cost. The high-stakes inventory carrying trap. Every single square foot of a commercial warehouse is a piece of real estate that constantly eats money, a reality measured by the inventory carrying cost. You are paying for heavy industrial electricity to keep the climate controlled, massive insurance policies to cover fire or theft, advanced security systems, and an army of forklift operators. On average, holding a product in a warehouse costs a shocking 25% of the item's baseline value every single year. This means if a pallet of goods sits unsold for 6 months, its profit margin is completely wiped out by the physical cost of its own storage. Wholesalers are locked in a permanent, high-stakes race against the clock, frantic to push inventory out the door before the overhead cannibalizes the business. The treacherous float and cash flow crises. Welcome to the most terrifying mathematical trap in the entire wholesaling industry, the cash flow float. When you purchase goods from a manufacturing plant, they frequently demand payment upfront or on rigid net 30 terms. However, your massive retail buyers like Walmart or Target hold immense leverage and will casually demand net 90 or even net 120 terms. This means you must deploy millions of dollars of raw cash to buy inventory, ship it across the globe, and then wait 4 agonizing months just to get paid back by your customers. Managing this massive working capital deficit requires masterclass financial gymnastics, relying on specialized revolving bank lines of credit and inventory financing structures where a single late payment can instantly trigger a massive corporate bankruptcy. The tyranny of the chargeback and allowances. If you think selling to giant corporate retailers is a dream come true, you have never faced the absolute tyranny of retail chargebacks and deductions. Big box retailers protect their own margins with a complex automated matrix of strict penalties. If your delivery truck arrives at their distribution center 15 minutes late, they will slap you with a massive late fee. If a single cardboard box on a pallet is slightly torn, they issue a compliance deduction. If the product doesn't sell as fast as they projected, they demand markdown allowances to subsidize their clearance sales. These hidden penalties are deducted directly from your invoice, meaning a wholesaler can easily ship out a profitable order and end up losing money due to algorithmic corporate rules. The high-tech magic of SKU rationalization. To survive the brutal math of a wholesaling empire, you have to become a completely heartless data scientist when managing your stock-keeping units, or SKUs. Amateur wholesalers make the emotional mistake of hoarding thousands of diverse products to please every single customer. The Titans, however, practice ruthless SKU rationalization. They utilize advanced predictive algorithms to trace the exact profitability of every single item down to the penny. If a specific product category is generating high revenue but requires complex handling or suffers from frequent shipping delays, the algorithm flags it for immediate deletion. You are constantly cutting away the weak, sluggish items, narrowing your focus strictly down to the high-velocity, low-friction products that effortlessly glide through your supply chain. The secret arbitrage of freight consolidation. The difference between a failing wholesaler and a billionaire empire often comes down to a hidden logistical superpower. Freight consolidation arbitrage. Moving heavy goods across the planet via ocean vessels, freight trains, and semi-trucks is incredibly expensive, and shipping rates fluctuate wildly by the hour. Smart wholesaling empires build massive, proprietary logistics networks that allow them to buy shipping space in massive, institutional bulk. By perfectly packing shipping containers to the absolute millimeter and consolidating smaller orders from different factories into unified, massive shipments, they can slash their transport costs by 30% compared to smaller rivals. They pass a fraction of those savings to the retailer while pocketing the rest as pure, unreplicable profit margin. The peril of phantom inventory and shrinkage. In the wholesaling game, what you see on your digital spreadsheet doesn't always match the physical reality inside the warehouse, a terrifying phenomenon known as phantom inventory. Between massive logistical clerical errors, misplaced pallets lost in the rafters, and internal employee theft, inventory quietly vanishes from the books. This is known as shrinkage, and in a low-margin business, a shrinkage rate of just 1 or 2% can completely wipe out an entire quarter's net profits. Wholesalers must invest millions of dollars into advanced RFID tracking tags, fully automated drone scanning systems, and continuous cycle counts to ensure their physical assets match their accounting data, turning their warehouses into tightly monitored financial fortresses. The omnipotent power of volume breakpoints. The ultimate goal of a commercial wholesaling kingpin is to achieve total market dominance through the weaponization of volume breakpoints. When you scale your empire to the point where you can walk into a manufacturing plant and offer to buy 100% of their factory output for the next 3 years, the power dynamic flips entirely in your favor. You can completely dictate the pricing terms, forcing the manufacturer to lower their unit costs to absolute rock-bottom levels. This massive cost advantage allows you to sell to retailers at a price that your smaller wholesaling competitors cannot even match on the wholesale market, effectively starving out your rivals and securing an ironclad industry monopoly. The multi-billion-dollar institutional exit. At the absolute peak of the commercial wholesaling ladder, your business stops being viewed as a simple trading company and transitions into an indispensable, systematic utility of national infrastructure. You own the strategic geographic real estate, the automated software playbooks, and the long-term corporate supply contracts that keep the economy moving. When massive private equity consortiums or global sovereign wealth funds want to deploy billions of dollars into inflation-proof assets, they buy wholesaling empires. The ultimate exit for a wholesaling founder isn't just counting daily unit profits. It is packaging a hyper-efficient automated distribution machine and selling the entire corporate apparatus for a massive, multi-billion-dollar institutional payout. The brutal math behind commercial wholesaling proves that real power in the global economy doesn't belong to the flashiest brands, but to the volume titans who control the hidden plumbing of distribution. Do you think the razor-thin margins of wholesaling are worth the massive financial risks, or would you rather invest your capital in higher-margin industries? Let me know your honest perspectives in the comments section down below. Smash that like button if this supply chain breakdown opened your eyes, and share this video with your business-minded friends. Make sure to subscribe to the channel and turn on the notification bell so you never miss our fun, deep dives into the mechanics of extreme wealth. See you next time.